Okay, let's go ahead and get started. Welcome, everyone. I'm Jim Hamilton, Professor of Economics at UCSD, and we're looking forward to a great event today, which we are recording and will make available on YouTube a little later. Please, if you have any comments or questions as we go along, try to indicate them with the chat button on your screen, and then we'll call on you when we get to the Q&A portion of our event. And feel free to stick around for a few minutes after that for more freestyle discussion. I think the topic today will generate quite a bit of comments, possibly. I know we're all looking forward to getting back together in person. Currently, the university is requiring events like this one to be held online. So both today and our next event later in the fall will be online Zoom events. One advantage of that is that it gives us an opportunity to bring in a number of our alumni from UCSD. So let me welcome our former students who decided to make a virtual visit back to campus today, and really glad you had a chance to join us as well. Our next event, as I mentioned, will also be online and should be a great one. We'll be talking about the future of transportation in San Diego and the world. That's November 16th, a Tuesday. We've scheduled UCSD Professor Mark Jacobson, who's an expert on those questions and really brilliant guy, a lot of common sense insight. And I think that'll be an event I'm really looking forward to. Let me also take this opportunity to thank our steering committee who helped guide our program. That would be Don Billings, Jeff Lewin, Joe Marshall, Terry Moore, Alan Nevin, John Reese, Manny Labrinos, and we welcome a new member to the steering committee, Melissa McGrain, who's the incoming president of the CFA Society. If any of you have any topics or speakers you're interested in for 2022 or general feedback, please pass it along to me or one of the other members of the steering committee. Let me also take this opportunity to thank our corporate sponsor, the CFA Society, and also our table sponsors, California Western School of Law, Terry Moore, Reese Investment Management, Sullivan Hill, and Xpera Group. And now for today's speaker. The very word cryptocurrency suggests something mysterious and scary, and its development raises all kinds of new questions for economics. Is the cryptocurrency becoming a new form of money? And if so, what's it mean for the Federal Reserve in the United States and central banks around the world in terms of implementing monetary policy? We're delighted to welcome one of the world's top experts on this question. Linda Schilling received her PhD from the Bonn Graduate School of Economics and started out as an assistant professor at École Polytechnique in Paris. She just accepted a position as assistant professor of finance with the Olin School of Business at Washington University in St. Louis, from which she's speaking with us today. Her research on cryptocurrencies has been published in leading journals, including the Journal of Monetary Economics, Review of Economic Dynamics, and Proceedings of the American Economic Association. So let me stop my share, and I don't see my stop share button. I guess we can do, oh, here we go. Sorry, we practiced ahead of time. So Linda, if you'll go ahead and share your screen.
Yes, thanks, James. Thanks so much for the nice introduction. Okay, so let's get started. Yeah, so thanks so much for having me. It's a real pleasure to be here and a real honor. Okay, so the title of the talk is Cryptocurrency versus Central Bank Money. And what I'm trying to do is over the 40 minutes to walk a little bit walk you through the notion of cryptocurrencies. How can they be understood as a currency? Why are central banks interested in cryptocurrency in particular? And why do cryptocurrencies affect us, even though we might not be investing in cryptocurrency. Okay, so for understanding cryptocurrency, what is a currency at all? Yeah, so economics, they define currency, the category of currency, via three distinguishing properties, namely, a currency is supposed to be a unit of account. You can count coins, pebbles, post-its, but counting water is tricky. Yeah. A currency is supposed to serve as a store of value. And with that, you might think of, well, if you go into the supermarket to buy avocados with your currency, then you would want the avocado price in terms of your currency should not fluctuate too much. Yeah. And then currency is also supposed to serve as a medium of exchange. Yeah. So the idea is that if you go to the supermarket, then in fact you can trade avocados for your currency. Yeah. So it's accepted and trade. And now, so how do cryptocurrencies come into this picture? Well, there's been a lot of debate about whether cryptocurrency are actually currency, whether they're an asset class, and so on. And so let's have a look at how we can put them into this category. Yeah, so they certainly serve as a unit of account. But in terms of the store of value property, Bitcoin, for instance, has been very much criticized. Yeah, so people have been looking at Bitcoin and saw huge price fluctuations across time, and said, well, Bitcoin is not a currency because it doesn't serve as a store of value. But I should point out already now, and we look a little bit in that topic in a few slides later, is that this is, of course, a matter of perspective. Yeah, so if you are living in the United States, or in the euro area, the euro and the dollar, they are quite stable currencies. So you can look at Bitcoin and say, well, this is highly volatile. This is not a store of value. But if you are situated in a country like Venezuela or Argentina, you might look at Bitcoin very differently. Yeah, so it's always a matter of perception how you judge cryptocurrency. And so what about cryptocurrency as a medium of exchange? Yeah, so is Bitcoin adopted for making avocado purchases, or so let's zoom into this a little bit. So since 2014, Microsoft indeed accepted Bitcoin on and off in its Xbox stores for purchases, and then since 2019 you can pay your taxes with Bitcoin in Ohio. And then just recently in 21, El Salvador, in fact, accepted Bitcoin as a parallel medium, as a parallel legal tender next to the US dollar. Yeah, so in El Salvador, there's been dollarization for 20 years now, but now you not only can pay in dollars, but also in Bitcoin. And this has been quite in the news. And I think politicians and policymakers are not yet sure how to think about that. But so this seems to be, not immediate. So we still think about, medium of exchange. Can we purchase our avocados in Bitcoin? And so let's have a look at retail, whether retail accepts cryptocurrency. And so it turns out that in an indirect way, you can very well spend crypto nowadays on a lot of different products via the so-called Speden app by Flexa. Namely, if you hold crypto, then you can shop at Whole Foods, Nordstrom, Barnes & Noble, Home Depot, Crate Barrel, and so on, not only in Bitcoin, but with Ether, Litecoin, Dogecoin, Zcash. Yeah, so in terms of adoption, there's been really a push forward by distinct cryptocurrencies. If we look at this graph in the Financial Times, just published 3 days ago, Bitcoin adoption not only moves forward in North America, but also particularly in Africa and Southeast Asia. So you could think about, well, why is this the case? So what drives the adoption of cryptocurrency? And in the news, crypto has been depicted very often as an object of speculation and a way to engage in illegal activities. Yeah, but there are also other reasons that drive Bitcoin adoption that make sense when we look at Argentina and Venezuela. And so this is, first of all, you can escape national inflation. Yeah, so if your national currency does not act very well as a store of value, then cryptocurrency might simply perform better. Yeah, so let's, for instance, look at Venezuela. The inflation rate is currently at 5,500%. Yeah. Or Argentina, we are at 51% in July 2021. Then again, so does crypto serve as a store of value? Maybe in contrast to the dollar or the euro, not so much. Yeah. But in contrast to the Argentinian pesos, maybe quite well. Yeah. Another way is, another reason for crypto adoption is that you can escape capital controls. And you can, and it allows people to engage in banking activity. So in particular in Africa, there are a lot of people that are unbanked. They do not have a bank account. So making payments is extremely tricky. Yeah. Or the banking system is very slow and costly to use. And so their cryptocurrencies have been really on the rise. Yeah. You know, there's still a lot of risks involved and so on, but better to engage in, to use cryptocurrency maybe that involves a lot of risk than not being able to make payments at all. Yeah, so I think these are the trade-offs that we have to think about when we look at Argentina, Venezuela, and Africa. Okay. So Vietnam, in fact, has the highest crypto adoption. And it's interesting to compare US adoption, which is just between Venezuela and Argentina, probably for different reasons. Yeah, so again, Venezuela and Argentina might be driven due to capital controls and inflation. And in the United States, you know, large financial institutions setting up crypto funds and so on. Yeah. So let's talk a little bit about the difference between cryptocurrency versus central bank money. And from a monetary perspective, there's a very crucial difference, and that is central banks, such as the Federal Reserve or the ECB in Europe, they can increase but also lower the money supply at close to zero cost at their discretion. Yeah, so they can meet and vote to increase or lower the supply, and by how much. Now, with a cryptocurrency such as Bitcoin, for instance, this is not possible. There is a protocol that fully determines the way the Bitcoin supply is supposed to evolve across time. Yeah, so it cannot be that there is no Bitcoin central bank that can all of a sudden decide we should increase the supply now more than the protocol decides, or we should lower the supply. So there's no way how Bitcoin could spontaneously react to events in the economy and therefore increase or lower the supply. Yeah. So if we look at this a little bit more in detail, let's look here at the Bitcoin supply across time. You see that the supply increases steadily, there's no decline, and the increase becomes slower across time. And so this is not a coincidence. So we are here currently at 18.79 million Bitcoin. And so what prescribes the increase of the Bitcoin supply is the protocol stating that at this point in time, roughly every 10 minutes, additional 6.25 Bitcoin are mined and are added to the supply. There's a so-called halvening going on. So the Bitcoin protocol foresees that roughly every 4 years, so every 210,000 blocks, these rewards, this quantity of Bitcoin that is added to the supply per block goes down by 1/2. And so therefore, slowly, the supply curve reaches its maximum of 21 million Bitcoin. And this is wanted, yeah. So in particular, there is no lowering of the Bitcoin supply. Yeah, and so you might argue now, okay, there are lost coins and so on.
Good morning.
Okay, but technically, was there a question?
Hi.
A question?
No, we're okay. I'm asking people to raise their hands if they have a question. I was just helping
yes. Okay.
remind everybody to keep yourself muted until we get to the questions.
Okay, so let's contrast the Bitcoin supply with the United States money supply. So what I've plotted here, I haven't plotted this. This is the Fred database. This is the M1 dollar money supply in the United States across time. M1 means this is currency in circulation plus deposits that citizens hold at banks, that they can use for making purchases, and traveler checks. So this is liquid means of payment. And you see here that in 2020, you have this super harsh increase in M1, which is due to the arrival of the corona pandemic. So central banks came together, and in particular the Federal Reserve, they've decided to massively increase the dollar supply to now 19.4 trillion US dollars. And so this sharp increase that you see here, this is for instance something that had not been possible with Bitcoin, because the protocol does not react to events in the economy. And if you look at the period before, just in January 2020, we were at roughly 4 trillion US dollars, meaning that there was an increase from January 2020 to July of 388%. So the Bitcoin protocol would not allow such an instantaneous boost in the supply. This is not possible. So there's no reaction to economic events. Okay, so this brings us to the question, how is cryptocurrency, in fact, macroeconomically relevant? Economists always ask these questions, are these things relevant to us? Then in terms of supply, you could argue, well, not so much. So the Bitcoin supply is only at 18.79 million, contrasting this with the quantity of dollars that are in circulation, 19.5 trillion. Well, this, Bitcoin does not appear to be dominant. But maybe the perception, just looking at supply, is not the right way to put it. So there's a different kind of way to look at cryptocurrency, and this is in terms of market capitalization. And market capitalization, the price times the supply of currency, is interesting because you instantly see the market cap of a currency can increase for two reasons. Namely, either the supply goes up, but the market cap can also increase via the price. And while the Bitcoin supply is prescribed by the protocol, the Bitcoin price is determined in the market according to supply and demand. And so there are certainly reactions in the Bitcoin price to economic events. So let's zoom into the market cap of Bitcoin versus national currencies.
So people being arrested. You mentioned the husband being arrested. So
I think, okay, so I would just go on. So the largest cryptocurrencies by market capitalization are, well known as Bitcoin, but then Ethereum also with $500 billion US dollars, and Cardano with 93 billion. So let's contrast these with national currencies. So if we look at this ordered listing, so M1 in the United States at 19.5 trillion, Euro area is 12.9 trillion US dollars, so converted into US dollars, China 9.6, and so on. So these are a lot of numbers. Let's zoom into a couple of details. When you look at Ethereum, roughly $500 billion US dollars, we see that in terms of market cap, Ethereum and the Swedish krona are close to identical. So Ethereum in terms of market cap has caught up with Sweden essentially. Likewise, we can look at Bitcoin and Ethereum combined. If you just add up these two numbers, you're roughly 1.3 trillion US dollars. And you see that Bitcoin and Ethereum combined have already exceeded the Canadian dollar. So they are roughly equivalent at the same. I say equivalent because there's a lot of fluctuation in prices going on, but Bitcoin and Ethereum have caught up with Canada. What about the United States versus Bitcoin? So roughly we are now at 4%. So the Bitcoin market cap is at this point at 4% of M1 of the US dollar. And then you might go a little bit back in time and might ask yourself a question, well, what about the past? Bitcoin has been fluctuating a lot. If we look at the market cap of Bitcoin across time, so this is not the Bitcoin price, it's the price times the supply, then Bitcoin reached this peak here in March 2021 of this year of $1.1 trillion. And now let's compare this to the US M1. Yeah. And so now you have to remember the US engaged in massive quantitative easing. So the market cap for the US dollar is also huge, but for a different reason, not through the price, but through the supply. Yeah. So if you look here at these statistics, March 21, we had 18.697 trillion US dollars. So in percent, at this Bitcoin peak in March, the Bitcoin was 5.88% of US M1. Yeah. And now you might argue again, okay, this was quantitative easing. Let's look a little bit back in time before quantitative easing. Let's have a look at this period here where the money supply, the dollar supply was not as high. And well, for Bitcoin, there was another peak in December 2017 in terms of market cap. And it turns out that during this time, in fact, Bitcoin was reaching a higher percentage expressed in M1 of the US dollars. But interestingly, it appears quite stable across time. So I'm not going to make a statement about this, but it was interesting to me. Yeah. Now remember, Bitcoin is not the total cryptocurrency market. It's the dominant cryptocurrency, but it does not reflect the total cryptocurrency market. So let's for a moment look at the total crypto market. So this is from 2013 until today. And if you zoom into the past year, just reading this number for you, we are currently at a total market cap on the crypto market of 2.3 trillion US dollars. Yeah, and so if you make the comparison of national currency market cap versus crypto, I think you should take into account all cryptocurrencies because not only Bitcoin can be used as a medium of exchange in the United States, for instance. So let's compare the total crypto market cap with national currencies. Because remember, we would like to assess the meaning of crypto to different countries. So for the US, the total crypto market is only 7.7%. Yeah, so this is it's a small number, but still, it's not zero. For the euro area, it's already at 11.7%. For China at 15.6%, UK close to 50%. And so from now it's getting interesting. So Canada 121% and Sweden 300%. So the current crypto market is 3 times larger than Sweden. Yeah. So are they economically meaningful? Probably they are. Yeah, and it's maybe not a coincidence that in particular Sweden, Canada, the Bank of England, and the Bank of China, they are very much looking into central bank digital currency. Potentially, we see the reason happening here. Yeah. Okay, but remember now, we still would like to find out how does crypto actually matter for central banks. Yeah, so we got a taste why they could matter, but let's a little bit get more into details here. So for understanding how crypto might matter for central banks, we have to understand what does a central bank do. Yeah, and so if you go to the webpage of the Board of Governors of the Federal Reserve System, you can read, so the Federal Reserve System is the central bank of the United States. It performs 5 general functions to promote the effective operation of the US economy and more generally the public interest. So the Federal Reserve, and you see this in the first bullet point, conducts the nation's monetary policy to promote maximum employment, stable prices, and moderate long-term interest rates in the US economy. And so the stable prices, price stability of the US dollar, this is something that I would like to zoom in now because my research is concerned with this point very much. And we will see that cryptocurrency certainly influences a central bank's capacity to keep prices stable, and I will explain to you now why this is the case. For explaining that, I have to start with a world where no cryptocurrency exists. Yeah, so how would the central bank typically keep prices stable, and how do things change once you introduce a cryptocurrency? So let's have a look. So there's a central bank out there, and the central bank observes real output across time. And you can think of it as the total apple production in the economy. So in the morning, the central bank wakes up and sees, okay, there are 5 apples in the market. The next day, there are 7 apples in the market all over. and so on. Now, the central bank not only observes the apple production across time, but also the prices for apples. Yeah. So there's a price that realizes for apples today, and the next day there's a new price, and so on. Keeping prices stable for the central bank means the central bank would like the apple price to not change too much across time. Yeah, so central banks, the Fed has a 2% inflation target, but for explaining things easier, let's assume now the central bank would like to keep inflation simply stable across time. Okay, so how can the central bank impact the inflation level, the price level of the US dollar for apples? Well, there's something that economists call quantitative theory of money. What this means is, so what is happening is the central bank takes the apple supply in the economy as given, and then there is an apple price. So on the right-hand side, what you see is the total dollar value of all apples out there. Yeah. And so this total dollar value has to be equal to the total dollars that are out there times how often each dollar is spent on apples per unit of time. Yeah, this is what we call velocity. And economists often assume velocity is constant over shorter time periods. Yeah, so we're neglecting velocity for now. Now then the following has to be true. Remember, the central bank controls the money supply in the economy. If the central bank increases the money supply and the real output does not change, if the central bank has no impact on output, then it has to be the case that as the money supply goes up, for this equation to remain true, also the price level has to react and has to increase. Yeah? Meaning inflation goes up. So the money supply under control of the central bank impacts the price level and inflation in the economy. And this is how central banks control the dollar price level across time. Okay. Now the question is, I've shown to you how this mechanism works with one currency, because the central bank can control the dollar money supply and therefore tries to impact the dollar price level. But there are issues as soon as you start introducing a second parallel currency as a medium of exchange, because all of a sudden you are no longer trading apples for dollars only, but also for Bitcoin, for instance. Yeah. So, and what I would like to do in the next slides is to walk you through the El Salvador case, where apples can be bought for dollars, but also for Bitcoin. And you will see that there's an effect coming that it's essentially lurking from Bitcoin, and it's going to impact the central bank's capacity to keep the dollar price stable. Okay, so how do we do that? Okay, so this is based on my research with my co-author Harold Wohlig. If you are living in an economy with two coexisting currencies, apples are traded for dollars and for Bitcoin, yeah, which means that the central bank still has the dollar supply under control, but there's now also a Bitcoin supply, which is given by the protocol. There's a Bitcoin price for apples. There's a Bitcoin velocity, and then there is the dollar price for apples. Yeah, so a lot of different variables, a lot of different things for the central bank to take into account. Yeah, and well, there is no Bitcoin central bank, so the central bank, the dollar central bank, simply has to take the Bitcoin protocol as given, and then can essentially read the supply of Bitcoin into the future. Yeah, so this is fine. This is not too tricky, but there is still the Bitcoin price out there, which evolves randomly across time. Yeah, and so this is where things are getting really tricky for the dollar central bank. And so it's not only the dollar supply and the Bitcoin supply that's given by the protocol, but also this random Bitcoin price for apples that's going to impact the dollar price for apples. Yeah, so all over, the central bank loses control over the dollar price level. Yeah, and not only that, but there exist in fact different dollar supplies that can attain the same dollar price level. So that's a lot of words now. Let me show you in a graph what I mean by that. Because remember, in the world where there was only one currency, the central bank would set $1 supply and then gets a unique dollar price level in return. This is no longer the case here now. What will in fact happen is if the central bank sets some dollar price level and a dollar supply D1, then if the Bitcoin price realizes here, the target in fact attains. But if the Bitcoin price realizes higher, the central bank would need to lower the dollar quantity for attaining the same price level. Yeah. So it's no longer the case that the central bank, just sets some supply and then gets its unique price level for the dollar. But the central bank would have to continuously pay attention to the evolution of the Bitcoin price. Otherwise, the price target might fail to attain. Yeah, so in a nutshell, things are getting more tricky for the central bank, but we are hopeful. So there's a way to resolve this equilibrium multiplicity problem. And this is if the central bank goes along and not only observes the Bitcoin supply, but also tries to forecast the Bitcoin price. Yeah. So if there's some reliable way for the central bank to forecast the Bitcoin price precisely, then the central bank is back to its former capacity of controlling the Bitcoin price target. If the central bank sets, this lower money supply, the lower target attains, and if the central bank increases the supply, then the higher target attains. Yeah, so that's good news. Okay. The theory also gives answers to the question: who does actually pay for the Bitcoin block rewards? There has been a lot of debate for who's actually paying for that. And if you assume for a moment now that the Apple production is constant across time and that the Bitcoin price would not move, and we keep the price target level stable. So what happens between today and the next 10 minutes is additional 6.25 Bitcoin will be mined. Yeah. And what happens then if the central bank would like to keep the dollar price level stable? Well, of course, the central bank would have to lower the dollar supply. Yeah, you see here, as the Bitcoin supply goes up, the central bank will have to draw dollars out of the economy, essentially through taxing people that use dollar for purchases. Okay, so let me wrap up. How does crypto affect central banks? Well, in a nutshell, first of all, it gets much more tricky for the central bank to target dollar price levels, in contrast to a world where the dollar was the unique currency. And so this is relevant for people that are living in a dollar world where they get paid in dollar, make purchases in dollar, take out loans in dollar, and so on. But there's another effect because all of a sudden it might be that people stop using dollar and start using Bitcoin only for purchases. And so this is interesting because this means all of a sudden there's a separate monetary ecosystem where the central bank, the dollar central bank, has no longer an impact on people that are living in Bitcoin world. So what do I mean by that? If you live in Bitcoin world, you get your income in Bitcoin, you make purchases in Bitcoin, you take out loans in Bitcoin. If the central bank keeps the dollar price level stable, this does not affect you here, not directly. So I've shown you previously, the central bank can keep the price level stable by observing the Bitcoin price and so on. But this, of course, then only affects people in the area here and not over there. Should be a little bit careful. There are spillover effects. So if the central bank engages in quantitative easing and credit easing so that firms can sell their bonds easier to the market, and if these firms also take on Bitcoin loans, this certainly, firms that are operating at the intersection here and take out dollar loans and Bitcoin loans, they certainly benefit as well. So there is a relation between the two. But generically, once people start, living only in this world, the central bank will lose its impact. Okay. What about cryptocurrency pricing? So there is a lot of debate out there how you should evaluate cryptocurrency. And let's dive a little bit into this question. So first of all, cryptocurrency, if you look at cryptocurrency as an asset, it allows you to shift consumption from the present into the future. Yeah, so economists call this consumption savings problems. And this essentially speaks to cryptocurrency's capacity as a store of value. And economists have been thinking about this problem for a long time. So this is standard asset pricing, what I'm going to walk you through now. So, you know, if you think of economic agents that would like to eat as many apples as possible today and tomorrow, but then of course they value apples today more than they do tomorrow, such an agent has to think about, well, if you're endowed with an apple supply today and tomorrow, should you save on apples, yes or no? And if yes, how would you do that? And cryptocurrency or assets give you a means to do this. Yeah, you invest some of your apples into cryptocurrency, and yeah, you purchase a quantity C of cryptocurrency at a price of PT. This reduces your apple consumption today, but allows you to eat more apples tomorrow. Yeah, so tomorrow you will sell your Bitcoin, and then these Bitcoins are going to pay off. Yeah. This kind of consumption savings problems, they have solutions that are well known in the literature. Namely, they pin down the Bitcoin price in terms of apples as the expected margin rate of substitution. So the willingness that you would like to trade apples or apple consumption today versus tomorrow, times the quantity of apples that 1 Bitcoin is going to pay you tomorrow. In formal notation, you can bring this whole formula back into what I've already shown to you, where QT is the price of 1 Bitcoin in dollar and PT dollar is the price of 1 apple. So why am I showing you this? This is essentially cryptocurrency pricing in isolation, as if cryptocurrency was the only currency out there. But we know that crypto is going to compete in usage with national currencies. So this pricing equation alone is not going to cut it. Yeah. So cryptocurrency is not isolated, which means that if the Bitcoin price is expected to rise, if people hold Bitcoin and dollars simultaneously, they would rather spend their dollars than Bitcoin. And the other way around, if Bitcoin is expected to fall, they would rather spend their Bitcoin than dollars. Yeah, so there are effects between expectations on Bitcoin and usage of dollar and vice versa. Yeah. So if people expect the dollar to fall, potentially due to quantitative easing, then people rather spend dollars than Bitcoin. Potentially they spend dollars on Bitcoin. Okay, so there's an equilibrium effect happening between expectations on one currency versus the usage and then re-evaluation of the other currency. What this means is if you are in a setting where currencies compete with one another, you have to take into account that that there is competition between the two, and relative price will have to adjust for people to be indifferent in making their payments in dollars versus Bitcoin. Yeah. And so how can we characterize indifference between dollar and Bitcoin trade? This is something else that we do in our research. It requires that an expectation, the inflation rates, the inverse inflation rates are identical. Okay, but so let me wrap up here. This, I think, was a lot of theory. Okay, so I hope I conveyed a little bit to you that so cryptocurrencies are maybe not relevant in terms of their quantity, but in terms of their market capitalization. Yeah, so if we look at market caps of Sweden and Canada, the global cryptocurrency market is already dominating. Cryptocurrencies do find wide adoption when financial restrictions are large, and if monetary institutions are not committed to keeping prices stable. But even institutions that do commit to price stability are affected because it becomes more tricky for central banks to target certain price levels to target inflation. Yeah, and last, quantitative easing might boost cryptocurrency prices, so cryptocurrency might act as a monetary disciplining device. Thank you so much for the invitation, and I'm looking forward to your questions.
Thank you, Linda, for some great facts, and also bringing not just our alumni back, but everybody back into the virtual classroom. Very informative. There are a number of great questions there. Why don't we start with Don Billings, who I see is already unmuted and ready to go here. Don, you want to take over? Don? Okay. Well, actually, one of his questions was shared by John Wicks. John, do you want to start the with your version of the question?
Am I unmuted?
We got you, John, and I don't know why
Okay.
Don isn't talking yet, but why don't you start with the topic?
Yeah, I guess, I mean, that was, I think Don started it, but I guess that's always been my big question is I think we assume that we understand the advantages of an elastic money supply. You know, COVID hits and you can, expand you can provide money that wasn't otherwise available. And then, similarly with 2008, right? I think we all recognize that things would have been a lot tougher had the Federal Reserve not had the toolkit that they have. So, yeah, I guess if we're talking about Bitcoin taking over as a currency in the fixed supply, isn't that a major disadvantage?
I'm not necessarily so I don't think that Bitcoin is going to crowd out the dollar completely, and so I don't think this is going to happen. I think, as you state, so why did during the financial crisis the Federal Reserve increase the money supply substantially? It has in fact to do with a different objective that central banks try to attain. That's to keep financial stability in the system. Yeah, so it depends. I think many economic agents would value commitment to a certain money supply. If you look around right now, there's quantitative easing going on. The inflation rate in the United States is increasing. So people are calling on the Fed to lower, to bring the money supply down. At the same time, the Fed is concerned about financial stability, and there's a trade-off happening. It's true that Bitcoin supply could not react to such an incident. And at the same time, the Fed is criticized for reacting potentially too much in favor of one goal relative to the other. Okay, so it's I agree with you on Bitcoin not being able to react there, but yeah, so central banks having multiple goals, multiple targets is also an issue.
So do you see, so then I guess the El Salvador experiment is a positive because it won't, the idea is that it won't supplant the US dollar, but we'll get a firsthand look at those two, I guess, living in harmony together.
Yeah, that's so El Salvador has no control over the dollar supply. Right. Which means that for them, the situation would be different than in the United States, where the Federal Reserve can increase the dollar supply. Yeah. So.
Okay, thanks. Sydney Karen had a point that I think is really important to discuss. Sydney, are you able to access the mic there?
Yeah, yeah. Of course, I'm not an economist, and this is an interesting exposition of the theory of how it all works in an economy where both Bitcoin and dollars are available to everybody to use for everything. But that's not the real world, at least not today. And my personal guess is it's going to remain not being the real world, at least not without some fundamental changes. So I'd like to hear some discussion about what is going on today and what can be done to bring Bitcoin from what I view as a rogue status into some reasonable behavior in the real world. Right now, if I were a non-qualified investor and I wanted to invest in some speculative investment, there are rules that say I can't do that. But if I want to put my entire life savings in Bitcoin, I can do that. That can't last in the economy that we have.
Yeah, so I think what you're aiming at is consumer protection when it comes to cryptocurrency, as opposed to different asset classes that are highly regulated. So
Well, that's only one point. There's lots of points about how Bitcoin does not function the way dollars function, not just the theoretical economics.
yes.
I could give you other examples. Ransomware is a great one.
So that, yes, that's exactly true. But I think, so the way I look at Bitcoin, Ethereum and so on, is that Bitcoin was never supposed to be functioning like the US dollar. Yeah, so that this protocol intrinsic in Bitcoin, which prescribes how the supply increases over time, is or should be understood, I think, as a commitment to a particular supply, whereas central banks do not commit to a particular dollar supply. Okay, and so when you say how can we make Bitcoin, calm down Bitcoin or domesticate Bitcoin, it's I think it's not possible. So the protocol is given, there is and is not changeable, and I think it's not supposed to be changed. I think this is not the objective of the or the original idea of Bitcoin. It's really about commitment to a particular supply and to see what's happening, as opposed to the US dollar.
So
I agree with you that certainly in terms of consumer protection, that there maybe things need to be done, because consumers are protected from investing in maybe fancy, tricky, risky options, but not in highly volatile cryptocurrency. Yes. Coming back to your point that the way Bitcoin currently works, it's not adapted or used. So I disagree with this, because so in the United States we are comparing Bitcoin to the US dollar, and the US dollar is very stable across time. But again, in Venezuela and in Argentina, this is not the case. So due to the capital controls there, people have no way to store value across time. And this really exposes them to a lot of financial risk. Yeah. So how do you save for retirement when you are forced to hold nationally highly inflationary currency? And so this is where cryptocurrency seems to offer a way out for these people, and where cryptocurrency basically can act as a disciplining device on these national highly inflationary currencies. Yeah, so
I'm going to follow up on that, Linda. So Sydney mentioned the role of ransomware, and you talked about capital controls. Is this actually something that China could not control if they set their mind to it? They control so much.
That's a difficult question, because the largest mining pools are in China, and China is very much pushing against Bitcoin, because of course Bitcoin is a means to bring money out of the country, to undermine capital controls. My guess is by tracking electricity usage, you can find mining pools, locate mining pools, and then enforce their shutdown. Can China enforce shutdown of mining pools out of China? I don't think so.
So I want to make one other comment, and then I'll shut up. But there's a certain element of this discussion that reminds me of early discussions of the internet, what it was intended to do, and people saying things like that it's, cyberspace is somehow independent of the real world, and if governments try to regulate it, the protocols will route around that as an error, and so on. It was demonstrably at this point extremely naive. And one reason I developed some confidence in the internet was talking to one of the real pioneers in the early days about just those kinds of pronouncements. And he pointed out to me, the governments have guns. And that if a government doesn't want Bitcoin to behave in a certain way, it can most assuredly make it behave in a different way.
I would. So I think governments can impact Bitcoin prices and so on by criminalizing the usage. Like when China was announcing to criminalize Bitcoin mining, there was a severe drop in the Bitcoin price, essentially due to mining pools being in China. There has been regulation that restricts the mining of cryptocurrencies or the use of cryptocurrency in trades and so on. So you, on the other hand, all these things are taking place, so partially electronically. I don't know how traceable things are in the long run, how sophisticated governments will be in tracking or in identifying individuals who make payments with Bitcoin and so on. But, my perception is that in the United States and in the Euro area, where currencies are very stable, these cryptocurrencies are mainly a speculation class. But in other parts of the world where people do not have access to such high quality nationally provided store of values, they may be really in need for such a cryptocurrency to exist. So I think there are not only bad sides to Bitcoin and crypto, but I think there are also bright sides to see.
Shelley White had a question about what you're saying about the supply of crypto. Shelley, are you there? Well, let me say your question. Go ahead.
I wanted to ask you about your graph that showed the supply of Bitcoin to be tending to a constant level.
Yes.
I think most of us think that the supply of Bitcoin is related to solving these math problems that take so much energy. So can you tell us how it why it's tending to a constant level?
Yes. So this is in fact by design. It's by design of the Bitcoin protocol that at some point the Bitcoin quantity will no longer go up. Yeah. So it's the ultimate form of commitment to a particular supply path.
Is that because the math problems get too difficult to solve, or do they just?
No, it's due to the halving of the block rewards, and eventually they will drop to zero. And so the idea is then, remember that the reason why these block rewards are essentially important is they are rewarding the miners in the Bitcoin system. And what miners are doing is they're validating transactions, and they are paid in terms of Bitcoin. They're paid by block, 6.25. And they're also paid with regard to the transaction fees that are also posted. And so in the long run, the block rewards for Bitcoin are going down, and the transaction costs are supposed to become more relevant for paying the income of the miners.
Can I ask a follow up on that? I thought that there were also there are a number of other cryptocurrencies that I thought were actually the supply was more related to central bank money supply. And can you comment on that? I'm being awfully vague because I don't know the specifics.
Yeah. So one I think what you might mean is so-called stable coins that are backed by national currency.
Right.
I think this is what you might mean. So Tether, for instance, is a dollar stable coin. One Tether dollar is supposed to be backed by one true dollar, and that's the promise. And so there is a relation to, I guess, the maximum quantity of Tether coins that could credibly be out there with regard to the money supply in the United States. Yes. Yeah. So these stable coins, they work differently because unlike Bitcoin, where the price fluctuates across time, stable coins are supposed to be stable in value.
But they're not currently big enough to affect your analysis.
Say again?
They're not, the supply of these is not big enough to affect your analysis?
So in the analysis, we look at Bitcoin in particular exactly because the Bitcoin price fluctuates freely. So the stable coin is stable by design. So the price is stable, and so there's no analysis to be done there. And it's in fact true that Tether manages to keep the Tether dollar stable against the dollar.
Okay, Don Billings, I think, is still having trouble with his audio, but he's asking some great questions there. So let me just bring them up. A few of the things he's asked, and maybe we can close with that. He pointed out, you mentioned the risk of the price changing. Is that the only risk? Is there any risk of hacking? There's no sovereign ensuring this. Who's monitoring the accounts, and how even do you report them in an accounting sense, for fair value? And is there any risk? I mean, you talked about the different cryptos. Is there any risk of that? So a lot of questions. He's got a whole lot more in the chat room, but
Yeah.
you want to take a shot at any of those?
That's totally correct. So there are a lot of risks involved with cryptocurrencies that are not necessarily involved with national currencies. So the risk of hacking is certainly relevant, or the risk of like the price fluctuations can be really large. If you live in a country like the United States, and you can have, one way to think about the US dollar as a store of value is really people think about their checking accounts as their store of value. You have deposit insurance on your checking account of up to 250,000 US dollars. So everything below this amount is safe, and cash is, as long as you're not subject to burglary, is safe as well. And but with crypto, you're certainly exposed to these tremendous price changes and cyber risk. That's true. In contrast, well, if you have your bank account checking above 250,000, you are also subject to risk. Yeah, so it's and in the United States, only 64% of deposits are in fact insured. So there are a lot of accounts that are above the 250,000 level. Yeah. So it's not the case that, and during the financial crisis, we have seen that there have been bank runs happening, and there have been people losing deposits. In Cyprus, the Cypriot banking crisis in 2013, for instance, people were losing their lifetime savings. So it's not the case that the banking system as we have it now is fully safe. Yeah. During the financial crisis, many firms had to be bailed out. This was paid for with taxpayer money. And so.
Okay, thanks for sharing your great insights. This is really informative. We always stop promptly at 9, and I'm going to do that. Remind people that there will be a video, and also we'll post the slides hopefully by tomorrow. And also, Linda's agreed to stay around for a few minutes if people want to just bring up questions about whatever, freestyle manner. So thank everybody for joining us. That will end the regular part of the program, and I'll go ahead and stop the recording now. And just anybody who wants to pop up can take the mic.